Welcome to the Wealth Wisdom, where money has history and knowledge becomes power.
Let me ask you something uncomfortable. If the financial system truly works for everyone, why do the same patterns keep repeating? Why do economic crises always end with ordinary people losing homes, savings, and stability, while a tiny elite emerges richer, more protected, and more powerful than ever before? Why does your cost of living rise faster than your income? Why does your debt grow faster than your savings? Why does your bank balance feel like it's leaking, even when you're doing everything right? And here's the mystery. If the system is broken, why does it always break in the same direction? What if it's not broken at all? What if it's working perfectly, just not for you? Today we're going to peel back the layers of how the financial world was built, who it was built for, and why the same few people always win no matter what happens. Let's begin. Origins to understand why the modern financial system benefits so few. We have to go back to the moment money stopped being just money. For most of human history, value came from physical things: gold, land, crops, livestock. But then something transformational happened. Governments realized that controlling the creation of money was more powerful than controlling money itself. If you can print currency, you don't need to compete. You set the rules. This is how the earliest banking empires rose, not by owning the most gold, but by controlling the flow of credit. Families like the Medicis didn't conquer land. They conquered the system that determined who could buy land. Their power didn't come from armies. It came from interest rates, loans, and influence. Money quietly shifted from physical to political, and this created the first divide. Those who live within the rules of money, and those who rewrite them. The next major turning point came centuries later. With the rise of central banking, nations were struggling with constant financial chaos, booms and panics, crashes and currency collapses. So central banks were created to stabilize economies. But stabilization came with a hidden consequence. A tiny group unelected, largely unseen, gained control over interest rates, credit supply, and national liquidity. Here's the part most people don't know. Central banks don't distribute new money to people. They distribute it to banks. Banks lend it outward. Corporations receive it early. Governments borrow it cheaply. The public receives the money last, after prices have already changed. This is foundational, and it sets up everything that comes next. Rise by the mid-20th century, a new era began, the era of financial engineering. Ordinary people still believed wealth came from hard work and saving. But behind the scenes, a different game was forming. Debt became a product historically. Debt was shameful, a last resort. But banks discovered something far more profitable. You can make more money lending than building anything tangible. Mortgages, student loans, auto loans, credit cards, business credit, government bonds. Debt became the engine of the global economy. But here's the trick. Banks don't lend existing money. They create new money through fractional reserve banking. Your loan is not someone else's savings. It is new money created for the bank, owed by you. The bank creates value from nothing. You repay it over decades. Multiply this across millions of people, and you get a system where debt fuels everything. Your income becomes collateral. Your future becomes the product. Markets became casinos. People believe the stock market is where wealth grows. And sometimes it does. But the real game operates like a casino with different rules for different players. Ordinary investors use their own savings. Institutions use billions in borrowed money. Ordinary investors react emotionally. Institutions act strategically. Ordinary investors panic in downturns. Institutions buy the dip with leverage. It's not rigged in a moral sense. It's rigged structurally. The same hand that deals the cards also built the table. Inflation became an invisible wealth transfer when central banks inject new money into the system. The earliest recipients, banks and corporations, buy assets first. By the time new money reaches salaries, prices have already risen. This creates an invisible shift. Your savings lose power. Your salary buys less. Your cost of living climbs. Meanwhile, asset owners watch their wealth inflate. Inflation does not hurt the wealthy. It protects the wealthy. Their assets rise. Their debts shrink in real value. Once again, a pattern emerges. The system moves wealth upward long before it trickles outward. Breaking point. Financial systems don't collapse randomly. They crack along the fault lines of incentives. And no example reveals this more clearly than 2008. People remember it as a housing crash. But beneath the surface, the mechanics were much darker. Banks had discovered an alchemist's formula: create risky mortgages, bundle them into securities, stamp them as safe, sell them globally, collect fees, shift the risk to someone else. Imagine selling a car with no brakes, collecting full price, and letting a stranger discover the problem. That is what happened. Risk was generated at the bottom, subprime loans. Risk was sold to pensions, funds, and governments. Risk was multiplied by leverage. When the system crashed, millions lost their homes. Savings evaporated, retirement accounts collapsed, and the banks, they were too big to fail. The public paid the price. The institutions that caused the damage received bailouts. This wasn't a malfunction. It was the system functioning as designed. Profits are privately owned. Losses are publicly absorbed. After the crisis, banks became bigger, more influential, more entrenched. The cycle continued. Fallout. Whenever the system cracks, the damage flows downward, and it takes three main forms. Wages stagnate while productivity rises. The last 40 years tell a disturbing story. Workers produce more than ever. Companies earn more than ever. Executives are paid more than ever. Yet wages barely rise. The value created by workers doesn't return to workers. It flows upward into corporate buybacks, dividends, and executive schemes. Debt becomes the only survival strategy because wages don't keep up with costs. Families rely on debt to fill the gap. Mortgages for homes that used to be affordable. Student loans for jobs that no longer guarantee stability. Medical debt for treatments that used to be attainable. Credit card debt to manage normal expenses. Debt becomes the price of participation. You don't opt into this system. You inherit it. You absorb it. You live inside it. Asset inflation creates a wealth trap when new money floods the system. Assets rise faster than incomes. Homes, Stocks, businesses, land, everything climbs out of reach. Ordinary people work harder, but fall further behind. Not because they are irresponsible, but because the financial ladder moves faster than they can climb. Failed fixes. Every crisis is followed by promises. We will regulate the banks. We will protect consumers. We will stabilize the system. But most of these fixes fall into predictable categories. Cosmetic reforms, rules that appear meaningful, but contain loopholes big enough to drive a truck through. Banks help write the regulations they're supposed to follow. They pass every stress test because they design the test. Temporary relief stimulus checks, eviction, moratoriums, short-term subsidies. These help people breathe, but not rebuild. They address symptoms, not structure. Band-aids that make the system even more fragile. Lowering interest rates makes borrowing explode. Bailouts encourage risk-taking. Market interventions make speculation rational. The system becomes more unstable, not less. It resets. It repeats. It deepens. Because the core incentives never change. Modern parallels. Look at what is unfolding right now. The patterns are unmistakably familiar. Record global debt. Global debt has surpassed $300 trillion. Household debt, corporate debt, government debt, every sector is stretched thinner than before the last major crisis. Asset prices detached from reality. Stocks reach all-time highs even when companies aren't producing more. Housing prices explode even when wages stagnate. Investors pour money into assets driven not by growth, but by the expectation of future bailouts and cheap money. Wealth concentration at unprecedented levels. The top 1% owns more wealth than half the planet combined. In the US, 3 individuals own more wealth than the bottom 160 million Americans. This is not coincidence. It is architecture. Crises are becoming more frequent. .com crash, housing collapse, pandemic crash, inflation, crisis, debt, instability. Each crisis transforms into transfer, from the many to the few. Patterns don't lie. They reveal design. What it all means if you zoom out. The conclusion becomes inescapable. The financial system is not designed to distribute wealth evenly. It is designed to concentrate power efficiently, not through conspiracy, through incentives. Those who shape the rules always shape them in ways that benefit themselves. Those who live under the rules bear the consequences. Systems produce the results they are built for. And this system produces upward wealth flow, consistently, predictably, automatically. Key takeaways. Position matters more than effort. The system rewards leverage, access, and information, not hard work alone. Crises are not malfunctions, they're mechanisms. Every crash redistributes wealth upward. Every bailout protects those already at the top. You don't need to beat the system, you need to understand it. Awareness is defense. Strategy is survival. Knowledge is leverage. Final warning, another major financial shift is brewing. Debt is unsustainable. Asset prices are inflated. Inequality is accelerating. Public trust is eroding. The question is not if the system will crack again. It's who will pay the price. Because once you recognize the pattern, you stop being a casualty and start becoming a strategist. If this opened your eyes, share it with someone who still believes the financial system is fair. And if you want more deep dive breakdowns like this, where economics, psychology, and power intersect, hit like, subscribe, and turn on notifications. There's more to uncover, and we're just getting started.